Hello, Daniel here, reporting live from Gothenburg. Today we're just gonna have a little small talk about big tech and its spending patterns and what is gonna be hard with the markets overall. So this is not financial advice, it's just me sharing my own view, my own stock positions and theses here on YouTube around finance and so forth. So, the big tech companies are reporting about a double the guidance about Capex spending, capital expenditures that one expected them to do in 2026. This is a thing that makes it really hard to be in the market and especially timing the market, timing market positions. I'm just going to highlight one comment we got on the channel the other day where one of my viewers asked me if it was a good idea to buy Google call options for 385 expires the second, and that call option is gonna expire worthless, which is really sad. And the thing is, and it's also as I write here in my comments to Oxzone, which is I believe that they will outperform on earnings. It's got a lot of things going for it. What's your price on the calls? No answer. But I also posted that's another 12% from today's prices. You never know what the market will react to. And as I said, they got a lot of things going for it, but options are very aggressive. I lost a fair share on them myself, on things I really saw as sure things, mostly leaps, which is calls expiring long in the future. It's like options expiring 2 years from now. They're called leaps. But from what I've learned in the stock market, and especially with options, it's very, very hard to time these things, which makes call options very aggressive. So in this situation where Google actually reports super strong earnings. So on the cloud segment, they made 55% revenue growth, which was 20% higher than one expected, which is insane. On the search one, which is their biggest business part, they made 13% growth instead of 12% growth, which is not that much of a huge beat, but it's still really, really good. So what is the market shocked about? They're shocked about their capital expenditure spending, about a double the spending rate as was expected, and all the big tech companies expect, except Apple is making these kinds of investment right now. So there's this kind of scare around the future margins on the AI products. You could watch on a lot of these type of different growth scenarios from history. One scenario that I tend to think of is the server build out for cloud infrastructure. When it first came out, one expected the margins to be way worse when the big tech companies, usually they stood for software, high margin. And when they were to stand for the hardware build out, one expected their margins to become way worse over time due to the fact that they were having to host all this hardware themselves. But they did not count accurately on what type of total addressable market they were to have after the rollout of this server build-out, which was way greater than they could have anticipated. And I would suspect this would be the same thing for this scenario right now, that the TAM is way bigger than one could think about. All the tech companies are talking about they're not able to service the need out there, and I can't really see how you would not have a great business going forward with all these hardware build-outs. You could listen to Michael Burry. I don't know what kind of intricate calculations he has, but he does really think that these big tech companies does write down its hardware way too slow, and that this AI software will be commoditized in the future, which would mean that it would become a very bad margin business, low margin business, which I don't know how he comes up with those numbers, but the big tech companies is clearly firing on all cylinders. They're growing a lot. They're gonna spend a whole lot now for the upcoming 2, 3, maybe 5 years. That will lay a groundwork for them to really be able to grow in the future. That is my thinking around this. Maybe all tech companies just will go bust in 5 years, who knows? But my point for this video is that it's very hard to know what the market reacts to. I don't buy options, and I don't buy options for that fact alone, that it's very hard to know what the market will react to. All the big tech companies are doing really well out there. Earnings has been really great, but the one thing that they focus now on is the huge capital expenditures out there. And I could understand that worry, and I really like it to slow down a little bit valuation wise, so these valuations don't come up and do some really crazy stuff. I much rather would have it grow slowly over time, so you don't end up with these schizophrenic moves, which is very tiring mentally. Of course, you could make good money on them, but it's very, very tiring mentally. So I would much rather it to be cooled down a little bit, maybe get hyped up a little bit, cool down a little bit, hyped up a little bit. That is a better way forward, I think. And one can always be grateful for the situation that you're in. And the work consists of you doing the things that you deem to be valuable for your positions and make good decisions over time around the growth stories that you have on your stocks. That's all that we can do. So I hope that you spend time with your positions, and I hope you spend time with your views, and that you continue to grow going forward. That's it for this video. I hope you're having a good day. Take care. See you in another one.